Welcome back to the Startup Saga, where we explore the founder's journey from spark to scale. In today's episode, we're turning to one of the most consequential and often misunderstood parts of building a company: money. Having explored the path of bootstrapping in a previous episode, this conversation looks at what it really means to work with venture capital. We'll unpack the strategic trade-offs between fundraising, the realities of equity and control, managing investor relationships, and what financial integrity looks like when growth, pressure, and expectations start to rise. To help us explore this from the investor side of the table, we're joined by someone uniquely positioned to offer that perspective, Dr. Tanja Emmerling. Tanja is a partner at the High-Tech Gründerfonds, or HTGF, one of the most active seed investors in Europe. Since joining HTGF in 2014, she has invested across a diverse digital tech portfolio from IT security to SaaS, and has seen companies in her portfolio reach profitability within just a few years. Beyond investing, she played a key role in mentoring and educating the next generation of investment managers, helping them to build and shape their own portfolios. In 2018, Tanja established and has since led HTGF's Berlin team, and she brings a strong conviction around technology that strengthens Europe's resilience, specifically through software and infrastructure. HTGF itself has been a cornerstone of the European startup ecosystem for nearly 2 decades. Founded in 2005, the fund now manages around €2 billion, has invested in more than 800 portfolio companies, realised close to 200 exits and IPOs, and generated billions in follow-on investment. As a public-private partnership backed by the German Federal Ministry of Economic Affairs, alongside major corporations, HTGF sits at a unique intersection between founders, industry, and long-term innovation. In this conversation, we go beyond pitch decks, term sheets, to talk honestly about what VCs look for, where founders often get fundraising wrong, and how to think about money as a tool, not a trap, on the journey to building something meaningful. If you're a founder considering venture capital, already working with investors, or simply trying to make smarter, more grounded decisions about growth and funding, there's a lot to take from this episode. Before we jump in, we prepared something you might find valuable. We created a free library of resources related to every episode in the Startup Saga founder journey. These resources are created by our guest speakers, and they will offer you practical support in your journey. Make sure you subscribe to the resource library on the link from show notes. Let's jump in. Hi, Tanja. Lovely to meet you. Thank you for joining Julia and I on the Startup Saga podcast. As you know, we're just going to dive straight in. We're going to start hitting you with questions because we know having someone like you on the podcast, our listeners are going to be excited to hear what you've got to say. Let's start with a big one. What's the real reason VCs choose one founder over another when they maybe have similar traction and tech? What truly tips the scale?
Yeah, thanks for having me. And so I think like the founder is the most important thing, especially if we are early investors. So the only thing we really can rely on to see the person that's in front of us. So really the founder makes the difference, because do we believe in the founder? Is he able to set up a company? Is he able to scale a company? Is he able to exit a company? Is he able to do the fundraising for the next round? So I think these all are criteria to see how much trust we have in anything else that he will tell us.
How do you judge that so early on? Because that seems to me such a subjective decision in many respects. So how do you make that decision about the founder when you first meet them?
Well, we work with them very intensively. So we have a due diligence process. And during this due diligence process, it also means you get to know each other. So we know how responsive is the founder, what does he tell us besides the business, how they work within the founders team, for instance, what's his real interest. You might get to know him personally better. So what's his personal situation? Can he really back up the entire process of setting up a company for him personally? What's what's his vision in it. I think you have a lot of time that you spend together in this process to getting to a term sheet or to getting to an IC decision, and there you see how does he work with critical questions, how responsive is he if there is still gaps in which he will or she will have for sure in all the planning that they are doing. How do they respond to any requirements, so you see a lot of them, and for us it's the best he will ever show to us, because now it's the sales process towards the VC company. And if that doesn't work well, saying, okay, 10 years from now we will work together, and and it will not be responsive. He doesn't really know what his numbers are. He's not very open and honest with you, so it would make it very difficult. So it's an important time. It's like a pre-marriage phase, I would say. So
Yeah, got you. Well, in that sense, then, what are the biggest sort of deal breakers that you see from founders, the things they do in those first meetings or early stages where you just go, that's it, we're out?
yeah, if there's a lot of overselling, you see right away the numbers or the metrics just do not work really how they present it. They're not responding to it, so the reportings might not be honest and true what they're presenting to us. If you see there are litigations already in the founders team, so and it's a lot of overselling. So I think that makes you suspicious that would go well.
Got you. I mean, for a founder, it's very difficult. You mention overselling, but they're sort of caught between two stools, aren't they? Because they've got to present a certain picture of strength, of confidence, of certainty about the product, the future, the scalability. But at the same time, what you've just said there is we need a little bit of honesty. So, with founders, when you're sort of talking to them at that early stage, what do you wish they would be more honest about, maybe?
I think first of all, we know we want to do the same business. We do venture capital. Venture capital will go to an exit. There are certain requirements of returns. So if you want to take this kind of capital on board, then you know which kind of, which path you will take, actually. So to be clear about that, so which kind of capital you will want to have on board. So that makes one thing, and you're confident that you want to do it. The other side is that, of course, we want to have the vision in the game. So it's really a VC game. Is the market large enough? Is the vision big enough from the founder to really do that? So that's where you think what you say, that's the confidence they want to bring in. There's a big vision to really sell the VC case to the VC, of course, in it. And I think so that's the one side of it. The other side is that they are very realistic about what they're going to do. So that's not just a lifestyle founder who finds it super cool and can tell the story, but we want to know, do they really understand their market? Do they really understand their product? Do they really understand what it takes to set up a company? What comes with it? All the issues that, and what we want to see is that they are really solution driven. So they see those points and they know they have in their hands a solution to deal with that gives you very much confidence. So if I trust my money and anything I will get back from that is just something like voting rights or information, but I'm fully in the risk with my money, giving it to you, I want to know they can solve problems along the way and they see them. So they're realistic about that.
Is there something founders often misunderstand about how VCs work or how VCs think in early stage, especially around risk?
Yeah, sometimes they're too much into, I want to sell the big vision. Of course, there is a lot more story than financials in it at the beginning, but sometimes I think, so that's all I have to sell. But of course, we know that we will take a long path, so on average, maybe have 8 years together, making a big company out of it. And of course, we know the struggles that will come on the way. And we want to give the trust that we will help them to set up the right cap table, to set up the right company things, to make sure that they're really going safely in this direction. And sometimes they take it very personally and they think it's going against me and they just, want to rule me over. This is not about that, because in the center of the interest is the company, to make a really interesting and big company. And it's not the founder itself, or it's not the product itself. So we are working on the company and we want to make it safely for everything that's around the entire company and the process towards the exit. And we want to make sure that everything is neatly and fine done. So sometimes they don't understand, they take it personally against themselves, for instance, or they forget that it's not about them, even though they are the most important asset in the company in first time. But we really want to have the big thing in the exit at the end. And then sometimes they take not the right, the argumentation to really get to that point in that thing. Or they forget, for instance, in the beginning, you also need to talk about financials. You have to show that your metrics work. That's do the unit economics work, really? So does it make sense? It's not only about the story. You want to know that you're able to work with what you're presenting to us. And sometimes, maybe too naive, but I think you also need to be that way in the beginning. Otherwise, you won't even try. So
you won't be successful long term. No, I mean, we'll definitely come back to the concept of the founder and the role of the founder within a company later in the podcast, because it's so important, and the changing dynamics of the founder role as the company grows is especially important. So we're really keen on your thoughts around that, and we'll definitely come back to that. One final question in this sort of segment from my perspective. If you could give one bold truth about fundraising to every founder listening, something they maybe realize a little bit too late, what would it be?
I would suggest them really do your due diligence also on the VC you talk with. Because that's the person or the fund you will work with for a very, very long time and take decisions together. And it's, I think it's totally fair to make you due diligence, to talk to other portfolio companies from them, also talk to other VCs they work with. So how does the investor really work being on the cap table? And I think that's relevant for them to know, will I be fine with that for a couple of years?
I think that's a great point, because I talk to sort of so many founders, and I think their focus is always they've got to raise, and they don't often think about that relationship that they're going to have with the funds that invest in them. So I think that's a really great point.
Yeah, it's too much, spray and pray to get the right one on the cap table, or to be too fast to take, I don't know, maybe a private person on the cap table that then won't be of much help later on in the process for getting more funds, or maybe will be difficult because they need liquidity, and then they don't think about too much in the beginning what's the right setup for the cap table. And sometimes they have so screwed cap tables that you really have to polish it up really to make them investable again. And sometimes they are too fast for the wrong money, instead of really thinking, really, what's the fund I really need on board, or who is going to tell the story with me, who would be preferably on board, and really set it up for the fundraising that way. Okay, sometimes you don't have the option, but you only have to think this also has an impact later on any kind of, shareholder meeting, on any kind of board meeting, on any kind of decision taking, and you have to be aware about that.
Quick pause for a moment to mention one of our founding sponsors for the Start-Up Saga podcast, the Dragon Coaching House. At the Dragon Coaching House, we partner with VC-backed founders who recognize that scaling a company requires their own evolution as leaders. Most of the founders we support are VC-backed. They are under constant pressure. They are expected to make clear decisions while carrying uncertainty, a lot of responsibility, and quite frankly, other people's livelihoods. Our work is rooted in Gestalt psychotherapy, coaching with ICF competencies, and real founder experience. Founders come to the Dragon Coaching House feeling stretched, reactive, or quite exhausted. And over time in our work together, they develop clarity, emotional range that allows them to lead without constantly operating from survival. The difference can feel like coming up for air after holding your breath too long underwater. We work with the nervous system, with how pressure lives in the body, and with the emotional patterns that shape how founders lead, relate to others, and how they decide. So if you're a founder who recognizes yourself in this, you can visit our website, dragoncoachinghouse.com, to book a private consultation. What is the underlying driver or the lack of it when someone doesn't do their own due diligence as a founder? Because as you said, it matters so much who you are going to work with. It's a long time and you have to take decisions together. What I like to always understand is what happens with a founder? Do you think that they don't go down this path properly?
I think, of course, they have a lot of pressure. You see how much cash you have in your hands, and you have the timeline that you need to get someone on board really to get it done if you're in that position. And of course, so you try to be, some of them try to be after the wrong VCs, in the sense of they are maybe too early, or they don't have the performance yet to get this kind of VC. They spend too much time on getting the wrong VC for their stage, for instance. Others do not think about it. So what would be preferably the best investor on board on the cap table? And then they do not start the whole process strategically. So to see, okay, that's the A class, that's the B class that I really want to have. And then I try to test it, listen to the answers that I get, and then work from that towards the one that I really need to be on board, to make the contacts, to get the references for it. And sometimes they just do it too randomly or too spontaneously, to think like, okay, I want to have the best US VC on board, but they are not really investing in that stage. So, and then they spend too much time on the wrong partner that they could maybe get on another time, but not in that stage, so.
Mm-hmm. So what I hear is that there's a lot of rush, and there's also rush in this pressure that they're in. And what could change this would be what, to step back a bit, or get advice, or work together with someone who helps them to first understand before they go into it. What do you think would help them to avoid this kind of mistakes?
Well, first of all, be clear about what they want and what's helpful for their business, and also for their financial strategy or funding strategy. And then really to make the due diligence to see like what's the right investor for that stage, and do they have experience in the sector? Where can they help? What's the add-on to the capital they bring to the table? Do they have the right connections? And then you have also the possibility to talk to them differently, because where are the points you can really get together. It's not just that you spend time like asking a VC for money that then has to explain, no, we are investing later, our expectations are now, because they won't say no. Then they would say, no, come back when you're ready. And then you're going in loops without really getting to an answer. And that's a risk of time.
Okay. So I think one interesting question for us is, what do you as a VC truly expect from a founder to accomplish between maybe a seed and a Series A? Is there some sort of expectation that is there, but it's not really spoken clearly, and maybe founders don't even know about that this expectation exists?
What they often do not think about is the logic that's behind it. So the seed investor gives a certain amount of money, and we know how long the run rate is for this money and when they need the next funding round. And sometimes they don't think about it, that getting to the next funding round, then you have to start fundraising, and that must be early enough before that. So that might be 6 months, 9 months before you get to Series A or get to Series B. So that's the point where you have to be ready, and means you need to have your numbers ready and your funding story ready to then start into fundraising. So the time from seeds and the cash you have to achieve the relevant numbers and or the product or the organization, where it has to be that you're really able to achieve the next funding round, it's very limited. And sometimes they forget that you need to work towards this. It's not just so you have the first seed money on board and then you drive, and then when you see you're going out of cash, then it will come the next round along just easily. So it's really hard, and you really have to know the next expectation that's behind it. So if the Series A investor is looking much more on the financial part, so what really do I need to achieve for revenue? How many customers do I need? Where's my organization? Do I have the right people on board? So this path has to be very clear.
One of the things that I've noted talking to founders, who are kind of between that sort of seed and sort of Series A stage, is that they're often still, sometimes haven't still quite found the right product market fit. And actually the ones that do get Series A funded are the ones that can demonstrate a fairly clear product market fit with, a strong, reliable customer base already. Maybe not a big customer base, maybe only one or two reference type customers, but they're committed, engaged, providing feedback. Is that something that is, kind of funders you look at, as a measure of whether they're ready for that kind of funding?
Yeah, exactly. So I think it's always helpful to have a pilot customer, a reference customer you work with, you challenge your ideas with, you challenge your product at. What I sometimes see is that they do not get out of this loop of product. We need another feature. We need to satisfy the customer here and there till they get to the point that you really have a product ready to scale the market. And to get there fast enough, I think you also need a concept to say, okay, I have my minimal viable product here. I'll test that. I make a marketing test. I make an A/B test. I take different references. I take the next step. I see like, what do I really need to scale and what I do not do yet because I do not need it to scale. And there's a lot of it's very, sometimes they're working on the product, they're very busy with that, and it's just driving along, and then the time is over and they are still not ready with the product. They have to sell another, post-seed round just to get there, and because they didn't make up their mind early enough a bit how to get to the next step. I think what every investor also after this wants to see, do they have the clarity how to get there, so, and give confidence on that. Do they really take the right steps?
Yeah, I really feel that clarity is so important in this whole process. It just shows up in every stage and in every aspect. Do you think that some founders raise money too early? And if yes, what does too early look like from your perspective or your side of the table?
Yeah, I think I always think the best thing is to bootstrap as long as you can, because it gives you time to get your product much further, or to make your company much more ready for fundraising, because fundraising is always about dilution. Of course, if you take shareholders on board and it's too early and there will be many more rounds coming after that, it's not necessary to have it too early on board if it doesn't help you. So what you need to know is, does the money that you take on board really get you further? If it's too early and you really cannot absorb the money for the right stuff that you're doing in the company, then it doesn't help, but you're diluted. So I would, as far as you can, bring the company bootstrap if you can. And I think it's much easier nowadays that there is AI and you need not so much money maybe in the beginning to do a lot of stuff, or not so much people on board just to get there. I think it makes it a lot easier to take that first step and be safer to take the first money.
I think that's a really interesting topic, and you mentioned AI there, so I think we should just dive on that while we can. I'm working with a founder now, not a technical founder, but he's developing a sort of SaaS ERP type platform that he's vibe coded to the point of MVP and 1-2 customers already, and that's pretty much bootstrapped. So how do you see AI changing the way founders can bring products to market, and then how does that then affect the sort of investment decisions you as a VC have to make, where the speed at which companies can evolve is maybe faster than it might have been in the past?
Yeah, I think you mentioned the right word. It's like speed. So things will be a lot faster. The entire development of the company also, because you can bring the product further a lot easier. You need less development capacity probably on board, and then you can scale easier. But that also means the expectations are a lot higher than in comparison to a SaaS company or something like that, where you will build revenues from there. So if you can scale easier, the expectations to scale actually are higher then. So it changes the KPIs and the expectation that the investors have, and that has impacts, of course, the valuation of the company and probably what you then expect to the end. So I think it makes all the entire, let's say, life cycle of a company changes a lot. But of course, they also have at the same time a market that goes very fast. So you have to say, does it really, the AI they produce, is it really competitive in the market 5 years from now? If you want to have an exit in it, is the exit money ready enough for such a high-speed AI? You don't know yet. So I think it's not getting easier, but it changes the expectation that you have. So it will go with the company you have. So if it's a different kind of company with AI going much faster, much faster development, different kind of scaling, it's of course where the investors also look at. It's not enough to say it's AI and that's why I have a high valuation. There comes the other side with it as well.
Mm.
And you mentioned before the dilution topic, and I was wondering, do you have any advice for founders about dilution? What should they know before they raise more funds?
Yeah, I just think like the founders should have at least seed and at least Series A, the majority of their shares still in the company, because there will be a lot more rounds coming up. And the danger is to give up too many shares too early, because maybe they want to start, then they want to have a first angel on board, or they have an accelerator, and then they give away like for 5-10% of the company, but then there is no input for the company to take them further, and then go to the first round. That's maybe not, and give another shares away, and they easily lose shares, even though they need a long way to go still with a lot of funding rounds. And I think like keep dilution as low as possible for the beginning, so that you can really make the long run, that's the long distance that you need to take later on.
I mean, that again, I'm just going to sort of pick up that point, and I'm going to ask a couple of questions on that, if I may. Is there, and I know every company's different and every founder's different, but is there a kind of rough rule of thumb that, you know, you as an investor would look at and say, okay, at this stage, this is what the cap table should look like. At this stage, it should look like this. You know, by the time we get to Series B, it might look like this. That a founder could sort of hear and think, okay, I've got at least a guideline of maybe what my cap table should look like at different stages.
Well, basically, it's to keep it as clean as possible, you know, not having several companies behind that, mixed founders, investment companies that are in it, then having, when they go into seed stage already, I don't know, a consultant in it that has already, I don't know, 20% or something like that, or they only have 60% of the company. So really the first investors they want to get and want to see that they have the majority of the company, because they know there will be a lot of dilution coming up. So in the first rounds, maybe they give up, depends how large the investment round is, but for sure, I think professional investors always want to have double digit if for the rounds they want to go in, and then you have to calculate from there. So what will it take till the company when you exit it? Is that so they're interesting enough to be the guiding person on board? I think that you have to think of.
within the cap table, and this is the sort of second question that I've got, getting those early believers, those early employees. And again, I think of some of the companies I've worked with where I've helped them find co-founders, for example. It might be a technical founder that needs a commercial co-founder, or, a strong strategic commercial founder, but then
Mm.
needs a sort of technical co-founder alongside them. Again, is there something that you would sort of say is a rule of thumb for how much of the cap table you might protect or reserve for co-founders, employees, again, to incentivize and ensure that the business is, got the right people, incentivized in the right way by a long-term goal?
Yeah. So first of all, we like to see teams, not a single founder that has the majority, but like a team of 2, 3 that really own the company, to have the company safe over all phases you might have, and these should have like more or less the same amount of shares, so you don't get into trouble then one is working for more than the other is working for less, or any kind of litigation that comes from that. So they have like a healthy environment between the founders. And if you need to get someone on board, I think you have to reasonably incentivize this person with shares to take the position that it has for the company. And there are different strategies. Something you should have shares for all the employees so that they're committed. I don't think that's very sticky on the long term. I think those who really drive the company with the responsibility that they take to the exit and will have long term on board, I think they should have reasonable packages for being incentivized doing that with the company together. So it should be a healthy distribution of shares between the founders and those that are having the main responsibilities.
Yeah, you mentioned something there that you look at teams, not just founders. And we talked about earlier founders a little bit in terms of that, sort of first pitch. But, actually, in many cases, it isn't just a founder. It is a team, 2, 3 people that have started and built something to the point where they're now coming to you for investment. So what are the sort of signals in early behavior, team dynamics, things like that you also maybe look at above and beyond purely the founder, which we spoke about a little bit earlier, but maybe in terms of that team that's important to you, either the makeup, the backgrounds? What do you look for?
Yeah, first of all, does the team match the company? So do they have any industry experience, for instance? Is the setup, right for the company? Do they have the technical expertise? Do they have the sales expertise? Do they have the knowledge for business administration on board? So is everything there to really set up the company, basically, in the founders team? And do they need that in the founders team? So in some companies, it's more important that the core IP is driven along with more technical founders. Others are more execution driven, that really need to go fast on large scale, so there's more responsibility there. So you have to say, does it really match what they want to do with their experience and how they want to drive the company? And then you have to say, how do they work together? Is there a person very dominant, and always overruling the others? So that could be an issue later on. Or do they really work well together? Everybody knows what their job is, and do they have a clear distribution? Who is responsible for what? Because sometimes that's an issue. So they are all just working, and then they didn't think about who was taking their responsibility for that. And are they able to then build up the company with more people? So are they able to lead the companies? And then what happens if the companies that scale, let's say like 100 people? So that will change the dynamics from really a founding company to a professional setup. So do they do that shift on their own? Are they thinking proactively what will happen there? And there's the right person? Do we need a different kind of management layer? Or do I want to step back at that point? Or am I still the right person for that and really want to drive it along? So there are different kind of founders, but the important thing is that they know that are actively thinking about these stages and how they work together. So
Is there something that, again, when you look at that team dynamic, that turns you off at the early stage where you just go, they're not investable?
Yeah, first thing is always if there are already litigations with them, so the shares are not well distributed, or they have one that's super dominant and is overruling the others. So say like, yeah, so probably will be difficult if then the more important role for a certain stage then is overruling the others. So that will be very difficult. Or if they're not fully on board, they have a lot of other side ideas, for instance, like I don't know, I don't trust them, they will really drive it so far. So it can be many things, but that's things that comes with experience, I think, and then really thinking about it, and also that they think about it with each other. So you sometimes have it if you're talking about the contracts and about vesting or leaver clauses or something like that. Then said, are they aware? So what happens if one is just leaving the company at one point of time? So is that really, are they really talking at partner level, or just thinking about of course we are all fine now, we have the same vision and go to the end. Do they really have a realistic view on what might happen also between them in the company? And one might have, I don't know, personal environment changes. Usually they're young, then they get a family, maybe that's too much pressure on the family, they get in trouble there. So that takes into account, because it's really a challenging job. So you need to think about those points as well.
I definitely want to come back to that idea about how founders grow as the company grows. And I know that's a topic Yulia's really passionate about. I've got one more question just about that kind of founding team before we move on. And like we and I have worked with a lot of companies where the founding team has come from, a university spin out or Fraunhofer, for example. And so you have a group of technical founders basically running a company, which then sometimes means they've got gaps maybe in the skill set in terms of company building, commerciality. How do you see beyond that? And how could you advise those sort of technical founders to sort of see beyond product and technology in a way then that would resonate with you as investors?
Yeah, I think we talk about it very openly. So we have like very technical founders. We have a lot in B2B, technology. So very often they come from a very technical background. And then you have to say, so do they have the skills to sell as well? Or do they have the skills to lead people? And if we think they don't, so you have to address the issues. So some are coachable, so they can help them to really get them the skill set, and maybe they're doing very fine. Others would say maybe you need someone on board. It could be co-founder, or it could be at a later point of time, a C-level, for instance, that would help you to take care of the employees that will get on board on certain. So they have, I think there are multiple possibilities how you can structure it. The point is, are they aware of it, and are they open for it, and do they have active solutions for it? So I think it's difficult if they're just, so now I can do everything and then I'm the smartest person, and say, yeah, but you will be the bottleneck for everything that comes after it. So that doesn't help you getting a big company in the end of the day. So that can be hard discussions, and you have to say that does it really make sense if you do not see what's necessary to drive it beyond that product.
What is the most difficult conversation you've had to have with a founder?
I think if you see that maybe you have a founding team, and maybe one person in the founding team, maybe they know that each other since university or even since childhood, doing a thing together, they have a really close relationship, and you see like one is really, really good and should do it, and the other one probably doesn't match with the company, is more like driving along with the other one, and say like, yeah, but really it doesn't make sense to finance both of you. You need a different setup. We really believe in one, and say, oh, we believe in you, but you need different partners on board, and I think you will be great. I think that's a really difficult situation for all of them.
Yeah, I can imagine. And have you had this conversation? How did they take it?
Well, I think sometimes they see or feel the same, but it's and sometimes it's helpful if someone from outside says like, it's really that way, you're right, and you need to take that step. It might sometimes make it easier if you do it from outside and have, the fundraising pressure behind that, then you just relied on yourself to make that conversation, and you're not going to do it because you will have, social obligations, for instance.
Quick pause for a moment to mention one of our founding sponsors for the Start-Up Saga podcast, Alexander Daniels Global. At Alexander Daniels Global, we work closely with founders, scale-up leaders and investors to help build leadership teams at the moments that matter the most. One of our key focus areas is C-suite and leadership search within technology, deep tech and innovation-driven businesses, often at points of rapid growth, transition or uncertainty. Over the years, I've had the privilege of partnering with founders as they make some of the hardest decisions in their journey, who to trust early, when to strengthen leadership, and how to bring in the right people to turn vision into execution. We work alongside investors, helping ensure the teams behind their portfolio companies are set up to scale sustainably. At its core, Alexander Daniels Global is about helping companies build teams that don't just look good on paper, but actually work. Teams that can navigate complexity, pressure, and growth without losing their direction. To find out more, you can visit our website at alexanderdanielsglobal.com.
I was writing on LinkedIn the other day about the topic of avoiding difficult conversation, how that can become very expensive if you think you can avoid it. And I'm just curious, from your perspective, how do you want founders to behave when something doesn't go right? What builds trust for you and what destroys this trust in that situation?
I think it's if the relation between investor and founders is always built on, have the transparency. So if they say, okay, I thought it's going this way, but I see this is going be problematic, it won't work out that way, that they early on address it and they come up with possible solution. If they said, I want sparring with you, I want to challenge this, I want to get your feedback. I think this has to be in constant conversation about doing the right way. You get a good feeling, you have the feeling how you can support them in the right direction. And that makes it very easy if you're getting in challenging times to have enough support from all sides. And I think difficult stuff, if that's not addressed and everybody is just shining, or they are lying about it, or they are not, or are keeping it behind the scenes and never addressing it, and you really have to find out that something's not going right. I think that's taking the trust, and that will be difficult in any other conversation. So that will be about any changes they want to make, and any financing route, it will be difficult because if you haven't taken along on the path on the right that they are going, I think that's the major issue: transparency and getting there with solution, openly.
Yeah, and this also signals a sort of maturity, that you go early on and you say, hey, this is the problem, I need help, or I need to challenge it, like you said, or I need to think it through, I need someone to help me to get through this difficulty. Yeah.
Yeah, and also like responsiveness and reactions. So I think there might be a problem with it. I do not understand why the product doesn't work, or maybe you're doing so much, nothing is converting, into revenue. So maybe there might be an issue, and if they just do not respond to it and say no, or always think they can explain it, but actually they don't. So that makes it very difficult then.
Yeah. So there's this, you can see it everywhere, that many founders are at some point replaced with professional CEOs. When I used to work together with Nick, we used to go into companies and get the task of finding this professional CEO. What could founders do, in your opinion, to develop early on if they want to stay in the CEO seat for the long run?
I think they need a clear picture if they really want to do that, because sometimes they like to be the founder and have all this culture and environment that is in the early companies. and they say they want to be in the driver's seat, but then the company changes a lot and is really an organization with all the processes that are behind it. So be honest to themselves first of all, if they really want that, and if they really have the capability to do that. And then I think there are various options to do that. And if they say, I really want to be on board, but I know I need someone who's more in the CEO position to help me with the organization, to maybe take a co-founder on board, or to say, I really want to be in a strategic decision. I go in the advisory board, for instance, and you take the operative business. I think that a lot of possibilities to do that, to manage that. Or if they know early on and said, I really want that, I think I can. So I take maybe more advisory or coaching early on, so I can be able to make that shift from, a 50 people business to 100 or more people business. So I think there are options, but you actively need to deal with it.
Yeah, you have to be honest with yourself. That's very important, right?
Yes, absolutely.
And if someone wants to
Just
stay
on-
just wait a second, Nick, if someone wants
Yeah,
to
carry
stay
on.
in the CEO seat and maybe they're not that good with people, what would you advise them to do?
And maybe they need then a C-level probably that is more in the lead with the people, and say like, so I'm in the strategic position to drive the company. Maybe I'm the face to the investors and the face and to the outside partners, but internally, and maybe I need a C-level that is working well with the people that I have on board. So I think it's possible, but I think you also have to be honest with them. Does that really drive the company to the next level, or is that better I do that, maybe from the advisory board later? But there are also founders who can really perform very well also in the big companies, and sometimes it's needed because they are so identified with the whole culture or product. So everything's possible. It's not necessary that way.
Thank you.
Sorry, Nick, it's definitely not one. It's all right. It's definitely not one size fits all. But I want to understand, maybe if you observe as companies grow, different stages of that growth, and whether for potential founders that are listening, things that they might typically need to be aware of. When a company gets to this size, these are the certain pitfalls I might face. When it gets to this size, these are the typical pitfalls that I might face. Because certainly in my observation, there are certain things at certain sizes we see time and time again in terms of hiring needs, for example, that come through that are translated because of gaps. But for you as an investor, do you see certain repeatable traits that come through in investments as they grow that founders can be aware of?
Yeah, I think like usually between like 50 and 100 employees, there's a lot of change in the company and also in the company culture with it, like to manage the people. I think there's a lot of shifts in the way I notice. Also, the founders notice, oh, it's different. It's not so much more my company or the founder's company. There are more people, driving the business, and then there are a lot of changes with it. And I think that's the time where you get aware of what's the management skill that you need at that point of time. And I think certainly beyond the 100 and 150 people, it's much more professional organization that is needed, and you really have to know, are you really have the right setup for it? But I think it also comes early on. If you say you have very professional salespeople, for instance, you get on board, and you're just starting off with the business out of a technical product, for instance, and then if you're not ready to know what are the KPIs I give a professional salesperson that is, of course, very experienced and absolutely knows how to get a bonus or a benefit from that, what's possible or not. You have to know what are the drivers in my company, because these are the main KPIs I also then have to give to the salespeople or the very experienced professional people that have more experience than I have, but I need to, incentivize them, drive them along. And that changes, of course, also the company, that how you deal with your financials, with your numbers, because you need it if you have a different set of people on board. So it's not just people who try out and go in the market. And then if you have professional people with that experience, they know what they do and they know how they benefit, you need to lead them somehow. And sometimes they forget that to do that early on, to understand their numbers and their tests early enough to really have the set of numbers, skill set, KPIs to lead the people on board.
We also talked a bit about money. What do you think separates founders who manage money really well and with integrity from those who maybe struggle to do so as the company grows?
I think it's startups are all about efficiency, so capital efficiency. Every dollar or euro that you have will turn into that you have the awareness. I think it's sometimes hard if they get early on a lot of money on the account that they cannot really absorb by the business or their rollout or the plans that they have, and then they tend to get into a lot of costs and spending that makes their company early on very inefficient and too expensive, and then they drive themselves into struggles with fundraising, cash out terms, which wasn't really needed at that point of time.
What do you think are some of these unnecessary spendings or inefficiency that at an earlier stage that can cause complications later on?
It's for instance, if they want to scale and they don't scale with the sales that they're doing, so now we need to hire a lot of people, and then you have a lot of costs on board, but you are not aware like what do the people need to get back to the company, what's the requirements for the sales that they what I expect for the conversion, what revenue do they need to bring, and to really to know what the cost they're spending, how much conversion into return will that bring, and then they are quickly into costs and cash burn for each month, and then they're losing control over that. Or if they are trying to be sometimes too professional, have the professional set up around it, even though they're still like working on the product and there's no need for it. So I think like efficiency is everything. So they have really the consciousness what with the euro I spend will really turn into. And this helps them a lot to manage also the time when you see where does the cash out come, when I need to get active, what are the possible costs that I can save when I need more run rate. And I think this awareness is very important that you can manage well your company.
Thank you.
The future of VC. I think this is an interesting sort of topic. It's become more difficult, certainly in the past few years, to achieve those kind of exits. IPOs, for example, have gone, sort of down, certainly in Europe, but also in the US. And so there's a growing conversation, I think, that the kind of VC model maybe is misaligned with founders. And there was a viral post, I don't know if you saw it, Guillaume Arbesh wrote about, that sort of talked about, perhaps a misalignment between, founders and VCs and misunderstanding really. How do you sort of see the future of VC? How does, the world of exits changing and obviously so much money going into AI affect your thinking about investment and founder relationships and things like that?
I think I just roughly read about it. I'm not sure it's about the entire content, but I think it was also about the investment cycle. So that's too short, that VCs want to exit too fast, and their company really is still building up, and they would actually need more time or not even in targeting exits. I would see that differently. For instance, our investment time is 5 years plus 7 years the investment, so there's a lot of time. On average we are 8 years or even longer with company.
Mm.
So I think like this investment cycle works well for the building up a startup. And but what you have to be clear about is VC business is all about exit. So if the idea is I want to build a company that I want to give to my children later, that's probably not the right money in it. What you do have to see, how does the exit market change, and I think this is the conversation we even do with very early founders, to say, so what's your universe of exit? Where do you want to sell your company? And they say, yeah, well, still I want to work 10 years with the company. Why you ask it me now? The world will be changed. But I think you constantly have to think with this where the market is going, because there will be a lot of changes, and maybe that forces you into a lot of pivots along the way. Maybe the company you sell is not the company you founded 10 years ago. That happens quite often. I think like this is a constant conversations you need to have to go in the right direction for an exit. And even their worst time in exits or better time in exits, to really hit the best time for your company isn't sometimes easy. It's just if you constantly know what's happening in the market and are there options, and that are options that are way too early because you have more options to come, or if you see like, oh, it's narrowing because everything is going AI and I don't have an AI product, for instance. So that can be done. But I think it's the various that you have. And it's a bit about the stage the investors go in. So of course, the seed investor will have a long time together. If you go later stage, then the life cycle for the fund lifetime is a lot shorter, and maybe they have much more pressure to go out of it. So you also need to know which kind of money you're taking. That's for sure.
Yeah, for a founder, when you say what type of money you're taking, I think that's a really important point. VC money won't be right for all founders, and we've spoken on this podcast to somebody who made that choice consciously, that bootstrapping the way he was going to go. In fact, we've spoken to two founders who've done that. It took them a lot longer in many respects. I mean, one we spoke to recently, I think it was sort of 8 to 10 years before he really started to see the compounding effect of all of that effort, and his ARR growing into the kind of multiple millions. So what, I know your game is VC, but what other kind of financing models do you see that maybe founders should be considering to help them get started? Obviously bootstrapping is one, but not everybody has that luxury. What else might you sort of suggest are those areas that founders could explore before VC?
Yeah, well, I think it depends a bit where they're about. So maybe a lot of scientific have chances to get grants in the beginning. They're large grants for certain technologies in the beginning. You could have angel money they don't have the same pressure. It depends really on the phases, or if you're able to take any kind of other warrants or loans on board. I think there are more possibilities. But also it will change, I think, with the AI question. When do they really need VC money? I think that changes a lot, because you don't need maybe so much money in the beginning.
And if you were founding a startup today, how would you approach fundraising? And does that differ from maybe how you might have approached it, say, 3, 4, 5 years ago?
Yeah, I think like working with VC, I have the understanding that the money is always leading towards the next money. So I would make up my mind earlier than I had thought before about it, that so what can I really do with the money I take on board, and for how much time does that work? And I think these drives, so calculating backwards where you want to start really taking money on board. So if you cannot move the needle really with the money you're taking on board, then it's probably too early.
And what do you think, is going to separate great founders, over the next 3 to 5 years in this sort of field?
I think it's always been, let's say, the ability to pivot. That means understanding the product good enough, the market good enough, to have always the view on the market, what will happen, am I still on spot with what I'm doing, and then have the ability to say, no, now I have to change it, I have to adapt. And that's not easy. If you're less invested a lot in a product, you have a certain structure in the company, and you're constantly working towards the pivot to be the leader, the market leader in that, so it'll be interesting enough for a buyer in the end of the day. I think that's the ability, because especially if you're a technical founder, then you love your product, you're into the technology, and you say that no, the market doesn't want it anymore, it's really, really hard. And I think this ability to understand what needs to be changed and not to stick too much to it if it's required, I think that's an ability that you will always need. And especially in the future, as it's going always faster than in the past.
Okay.
We're
coming. Oh, sorry, go on, Julia.
No, I just always say you need resilience, because in order to pivot, you need to be resilient. And in order to pivot, you also need to be aware, and awareness helps you to gain clarity. So there's so many human aspects into becoming a great founder, and to actually having a good relationship with your investors, and also having a successful company in the end. It's always kind of like the angle I kind of go back to. It's almost at the root of a lot of the important things that we're talking about today, but also that I see on LinkedIn when everyone's talking about. Sometimes I think I just have this a bit tunnel vision, because this is what interests me. But if I drive it back to the source of what drives something good, it's all of these human things. What do you think about that?
Yeah, absolutely. I think they need a lot of social abilities and to manage along, because a lot is a personal, it's a personal invest on your side, and you have a lot with people that will invest a lot in your company. So you have to be able to drive the conflicts. Then you go with that to go the downsides and the upsides for everyone. So it's more emotional than you actually think. So I think you have to take, you need that abilities. Absolutely. Yeah.
It's a great personal development tool as well to start a company.
Yeah.
It's the fastest way to an MBA, I think. Why pay for one when you could start a company and do it practically? We're coming towards the end, so we've got a few more questions to ask Tanja, which are quick fire questions now. These are sort of, fast, quick responses that you can go. I'm going to ask the first one, because I think this is a really interesting one. What's the one company you said no to that went on to become a huge success?
I don't want to name anyone then, but let's say an anti-portfolio that what I would have. It's sometimes it's maybe I had miscalculated the possibility of the scaling that could be behind it, and then they would say like I wouldn't count on the fast going story in it. I have a couple of them in my anti-portfolio. We won't name that.
Okay. Yeah, the one that got away, so to speak. Yeah.
All right. So what's one hype-driven fundraising trend that you hope will die quickly?
I think the overuse of AI. So AI is really, if it's not really deep AI, but it's just, let's say, a sticker on it and have high valuations on it. That's, I hope that will go from the overhype to the real deep tech.
What's one piece of advice you give to every founder privately, but rarely gets said publicly?
I think it's the issue about doing your DD on the person you work with, because it's more time than the average marriage you're spending together.
Thank you so much. Where can the listeners learn more about you, HTGF, or how can they approach you to learn more or to get in touch with you?
You can get in touch with me or any investment manager you find on the websites. Everybody is open to take your pitch deck. We talk every week about the deal flow that's coming in, and everybody gets an answer and then feedback if you want to continue with them.
Awesome.
Fantastic.
Thank
Good
you
stuff.
so much.
Thank you, Tanja. That's been really great. Have you got time for maybe just one or two, maybe what we would call bonus spicy questions that could form part of a kind of bonus features episode or something like that? It literally just a couple of questions. What's the worst pitch behavior you've ever seen?
Oh, I had one that said like my technology is so secret, I don't want to reveal it. And what are we gonna do in a pitch now? So it was really hard. So we had to go together to the notary and do it in front of the notary because we thought it's too secret to
Too
reveal it.
secret.
And
Yeah. Did you invest?
No, in the end, it wasn't that. It wasn't that's big of a world news, I'd say.
Right. Have you ever said no to a founder that you really liked, but didn't invest in, and why?
Yeah, that actually happens often because I think they're great people, but then you say you're not there yet with the whole setup, or it doesn't make sense in the way you thought of it, or there were too many issues in cap tables and construction they had behind it. They were too late for our investment focus or something like that. So it happens quite a lot, I think. But sometimes they also come back and they really come up with a different startup later on, and they are really doing well.
Oh, fantastic. And then one final question then. What question should every founder ask you or any VC before they say yes to investment?
I think how do they support them? So what they can bring to the table regarding contacts or winning, where they should call them if they need help, and how they work with them.
Brilliant. That's great. Tanja, thank you so much. It's been really, really great talking to you.
Thank you so much. Bye.
Bye.
Bye.